Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, November 1st. First month of Q4 in the books. What did we learn? What are we looking at? In terms of equity markets, the last 2 weeks, you really got just what you needed. You got the market through the end of Q3 into Q4, early October, running hot. Maybe it got a little too hot. We've had a mild pullback. And the things we're looking at in this pullback is where are different securities and different sectors and different industries trading versus the August pullback. Perfectly normal to generate weakness short term after a monster run. And really that's what we've had. What we want to see is this pullback end above the August levels. That just means a higher low. Just means that in this pullback, there wasn't as much supply or there was more demand for equities. Microsoft, perfect example. We're long Microsoft. In August, post earnings, they sold off all the way down into the 390s. This week, right in the 405 area and has rallied today. This is rallying in Friday. We'll see about next week. In terms of how we view this, from a technical standpoint, is Microsoft just trying to put in a higher low versus last quarter. That's healthy. What would concern us is if that 390, 392 from last quarter couldn't hold and Microsoft traded down through that name. Now, I'm using Microsoft for an example, but you can substitute any sector, industry, or stock that you're long or you own and look at the same type of thing. How is the price action versus the last time the security sold off? It'll tell you an awful lot about positioning within the security. So, as I said, we got just what we wanted if you're long equities here over the last couple of weeks. Needed to take some of the froth off. We've pulled back to a level that's much more reasonable than 4 weeks ago. October ended up being flat. S&P flat for October. Some of the other indices down, leading us into the tail end of the calendar year that tends to be strong on the stock side. Well, we're certainly going to be impacted by interest rates. There is no asset class that works only by itself. The intermarket trading is a real thing, and we need to keep an eye on interest rates and commodities. Got a nice break on the commodity side as oil has started to pull back. Got a little late week move in oil, but net has pulled back nicely. Interest rates, 10-year, 435, 436 on the 10, maybe a tick or two or three higher than I'd prefer. I wanted to see that 424 and a quarter act as a cap. But again, it's not the fact that rates moved through that level, it's how long do they stay above that level? Not overly concerned if they poke their head above that level and then start to retreat. As a matter of fact, often we'll see that type of price action because of the positioning of everybody looking at 4.25 or so. So we have our traders' eyes peeled for opportunity in fixed income. We have our traders and managers' eyes peeled in industrials, financials, some areas of tech that are getting a touch oversold. Should be a real fun last 8 weeks of the year. Moose is next. He has some thoughts, some ideas on fixed income. And I've got my Breeders' Cup tie on. Great horse racing this weekend.
Hi, I'm John Musso. I'm the CEO, Director of Fixed Income at Cumberland Advisors. It is Friday morning on November 1st. This is the bond report. This week, bond yields up a little higher. Treasury yields 428 on the 10-year, up 4 ticks. Long end pretty unchanged at a 450. And if you look at the shorter end, really unchanged, maybe up a tick. And so not a whole lot of movement around. What did we have today? We had a jobs number that was a heck of a lot lower than expected. 12,000. Expectations was 100,000 on the jobs number. I'm not sure what you can read into it. A lot of noise in there. What do we have? We have the storms. We have the Boeing strike. So To say there's not a lot of noise in it would be disingenuous. There's a lot of noise in it. We're going to have to see how this plays out. What we do know is that yields in general have risen, and they've risen across the board. Only about half as much in munis as treasuries over the last few weeks. Muni yields, 10-year AAAs around at 3%. That's up 3 or 4 ticks this week. But here's a chart, and we've talked about this before, and it shows the odds on betting in the election, in the presidential election, Trump versus Harris, and it goes back to the period of time right after the Biden-Trump debate. And you can see at that point, the Trump numbers surged. Bond yields moved up. Bond yields were almost at 4.5 on the 10-year before Harris decided to go in the race and Biden pulled out. Then polls narrowed, yields came down. Now we did have some lower economic numbers. We did have a little bit of noise in there that pointed towards a little bit of weakness. But the most important thing, I think, is that you saw the chance for divided government to be stronger in a potential Harris election. In the last few weeks, really since the Fed's decision on September 18th, you have seen the Trump odds on winning the election go higher. They are very correlated here with the 10-year bond yield, which has gone from about 370 on September 18th, the last time the Fed met, to right around where it is now. And that's been a very sharp rise, not with a lot of strong economic numbers, good economic numbers, not really strong. For example, this week you had the weaker jobs number. You had PCE data that was very good, right in line with the Fed. PCE year over year now at 2.2%, so or 2.1%. So that is really getting towards what the Fed wants. If you looked at really 8 years ago, when you see Trump versus Clinton, Hillary Clinton, you don't see the same kind of magnitude. You see a rise in yields, but the rise in yields came after the election. I would suggest that the rise in yields that you have seen here with the expectation of a Trump victory, and we don't know that because the polls are essentially tied, I would say a lot of the work has been done by the market already. So, the ceiling for how far rates would rise after a Trump election, we think that's a fairly low ceiling given how far they've already come. We will know. Of course, we have the election next week on Tuesday. We will urge everybody to go out and vote. And of course, 2 days later, we have the Fed rate decision. Now the expectation is 0.25%. We know they lowered it 0.5% last time, maybe 0.25% this time. That would be in line. Remember, Jay Powell said, don't expect the 50 basis points to be a roadmap for every rate cut. So 25 would seem to be in the cards. We hope everybody has a great weekend. Again, we urge you to vote, and we will see you next week. And who knows? We may not know who the next president is at that point. Have a great weekend.
Thanks, John. Enjoy the weekend, everybody. See you next week.